Howdy, everybody. Welcome to Liberty Call. Today is Friday, July 26, 2024. Hope you're having a fantastical day. It's almost the weekend. Woo! Yeah, it's kind of overcast today, which I don't mind. It's keeping it a little cooler. We got like 90-degree days coming up over the next 3 or 4 days. I think actually like Monday through Wednesday of next week. So it's going to be a warm weekend. So plus I got a lot of chores on my docket. So anyways, I hope you got some fun things to do this weekend. And if you could do me a favor before we get started, give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell. Markets were in a much better mood today. I have no idea why. I guess, we got the Fed meeting coming up next week. I think there's hopes that the Fed's going to, sprinkle some of their magic fairy dust across the economy, lower rates, a whole 0.25%. That'll certainly fix everything that's wrong with the U.S. economy and, the global economy and all the inflation that they've created over the last couple of years. So, all right, let's get into the numbers. Dow Jones was up 1.64% today, 654 points, closed at 4589. The S&P 500 up 1.14%, 61 points, closed at 5461. NASDAQ up 0.05%, 179 points, closed at 17,361. The VIX fell 11.21% today. It's at 1639. Canada up 0.91, Brazil up 1.29%, and Mexico down 0.38. Headed to Europe, Germany was up 0.68, the UK up 1.21%, France up 1.22%, the Netherlands up 0.9, Spain up 0.18, Italy up 0.12, Switzerland up 1.11%, and Portugal down 0.73. Russian exchanges both in the red today. The MOEX down 1.63, the RTSI down 1.81. And the overnights, the Nikkei in Japan was down 0.64%. Australia up 0.76. New Zealand down 0.19. In China, the Shanghai was up 0.14. The Shenzhen Component up 1.45. China A50 down 0.38. DJ Shanghai up 0.36. Hang Seng up 0.1%. And the Taiwan weighted has not been open since the 23rd. All right, so those are today's markets. Very, very exciting stuff. All right, let's get over to the markets for the week. And come on, 1 week. Where is it? Why isn't it working? Oh, oops. Where'd it go? There it is. All right, so we'll go back to 1 week. It was like acting weird on me there. All right, so the week started on the 23rd. Let's take that off. And starting out with the Dow Jones, looks like it's going to be in the positive a little bit. So let's see if I can snag that last candlestick. Up about 0.58%. The S&P 500 in the red this week, down 1.43. The NASDAQ also in the red, down 3.14%. The Dow Utilities going to finish up about 2%, and the Dow Transports up about 0.62. So looks like the Dow was up about a 0.5%. We said the S&P was down more than 1%, and the NASDAQ was down like 3%. So, all right, well, let's zoom out and see what things are how the charts are shaping up here. And starting out with the Dow Jones, we can see going back to like mid-April, we've had some downtrends, but they've bounced off this line of resistance, and looks like we have not broken below the previous high, the previous highs we've had before. So again, kind of waiting to see where this is going to go. The S&P and the NASDAQ are very different charts. You can see here if we zoom in, broke this line of resistance the 18th of July, and has been in a downward trend since. The other thing I'm looking at is, for it to break this previous peak, give us some certainty on, is this trend going to continue longer, or is this just kind of a blip right now? So same thing with the NASDAQ chart. It looks very, very similar. So. All right, so that's some charting for the week. Do you feel smarter? I know I do. Oh, wait, I'm the one talking. All right, let's get to the economic data for the week that was. Initial jobless claims came in at 235,000. Forecast was 237. Previous number 245. Continuing claims. Get off my screen. God damn it. Continuing claims came in at 1.851 million. Forecast was 1.86, and the previous number was 1.86. Existing home sales came in at 3.89 million. The forecast was 3.99. Previous number was 4.11. And the last, really, since March, we've been in this little trend going this way. Month over month, existing home sales contracted by 5.4%. Previous number was a contraction of 0.7. New home sales grew at 617,000. Forecast was 639, and the previous number was 621. Month over month contracted by 0.6, and the previous number was a contraction of negative 14.9. GDP came in at 2.8%, way over forecast. Forecast was 2, and last quarter's final number was 1.4%. So bit of a surprise there. I personally didn't think GDP would come in even at 2%, but again, I'm kind of going off of very broad numbers, and again, I'm not digging into the statistics every week like the folks, the economists over at First Trust, who usually are fairly close. U.S. durable goods orders month over month contracted at 6.6%. Forecast was 3.3% growth. Last month's number was a 0.1. And personal income month over month grew at 0.2%. The forecast was 0.4, and was also the 0.4 was also the previous. Personal spending grew at 0.3, right on forecast, and last month's number was also a 0.4. And lastly, to finish up the data, the U.S. Michigan consumer sentiment came in at 66.4. Forecast was 66. Previous number was a 68.2. And we can see really since the early part of this year, it's been just trending down, down, down. All right. Well, that is all the data that we can learn today. So I hope you feel smarter and that you learned something. All right, let's get to the market recap. U.S. stocks in rally mode as cooling inflation boosts rate cut hopes. U.S. stocks surged on Friday as data showing continued cooling in inflation raised hopes for an imminent rate cut. The optimism pushed Treasury yields lower and spurred dip buying in previously battered tech stocks. The Personal Consumption Expenditures Index, the PCE, a key inflation metric preferred by the U.S. Federal Reserve, rose by 0.1% in June and 2.5% annually, both aligning with expectations. While the upcoming Federal Reserve meeting next week is considered too soon for a rate cut, Macquarie suggests that the Fed is likely to set the stage for cuts beginning in September. We expect the FOMC to leave the Fed funds rate unchanged next week, but for the communication to foreshadow rate cuts ahead, Macquarie stated. The anticipation of rate cuts led to a decrease in Treasury yields, which in turn boosted tech stocks that had recently underperformed. Investors took this opportunity to buy the dip, especially ahead of major tech earnings reports from Microsoft and Apple, scheduled for Tuesday and Thursday, respectively. Microsoft's results are particularly anticipated as investors seek signs of its cloud business, Azure, capitalizing on the AI trend. UBS noted that investor focus likely will be on CapEx trends and the return on Microsoft's AI investments, particularly the impact of Copilot on Office growth. Other significant earnings reports expected next week include those from AMD, Qualcomm, and Amazon. On the earnings front, Bristol Myers Squibb saw its stock rise by 11% after reporting better than expected second quarter results, driven by new products and its top-selling blood thinner, Eliquis. 3M Company soared 21% after raising the low end of its full-year adjusted profit forecast, expecting benefits from restructuring and increased demand for electronics. Decker Outdoors also rose 7% after raising its annual profit forecast following strong quarterly results. Conversely, Dexcom saw a significant decline, with its stock dropping 41% after the medical device maker cut its annual revenue forecast, citing fewer new customers than expected. Well, then we need to make more people sick. I mean, the food industry is doing a good enough job of that, and the medical industrial complex, pumping us full of drugs we don't need. So maybe they'll have better luck next year. All right. Next up, got some data on the June personal income and consumption. This comes from First Trust. Mr. Andrew Opdyke is the economist who prepared this. All right. The Federal Reserve has received the final key data before its meetings next week, indicating that rate cuts might begin in September. The PCE price index, the Fed's preferred measure of inflation, rose by 0.1% in June and increased by 2.5% in the last year, down from 3.2% in the previous year. Core prices, excluding the volatile food and energy, rose 0.2% in June and 2.6% annually, showing significant improvement from the previous 4.3% increase. Although inflation remains above the Fed's 2.02% target, these positive trends suggest progress. Consumer data for June showed moderate growth, with the personal income rising by 0.2% and a 4.5% increase over the past year. Private sector wages and salaries grew by 0.2% for the month and 4.1% annually. Government-related economic activities also surged, with transfer payments up 0.3% in June and government pay rising by 0.6%, marking an 8.5% increase over the past year. Well, you're welcome, government parasites. The largest in over 3 decades. This level of government spending and pay growth is seen as unsustainable and potentially harmful to the U.S. economy. So when you federal employees lose your jobs, too bad. Consumer spending rose by 0.3% in June, driven primarily by a 0.4% increase in services, which are up 6.8% over the year. Spending on goods increased by 0.1% in June and 2% annually. Adjusted for inflation, overall consumption rose by 0.2%. The services sector remains a crucial driver of consumer activity, but its growth is expected to moderate due to high interest rates and ongoing inflation. And earlier today, I'd gone into the Bureau of Economic Analysis and was going through the consumer spending charts, and it was really just looking for anywhere in the spending patterns of the subcategories to see, well, where is, I imagine it's got, we got to have spending slowing down somewhere, and really just couldn't find it. In some areas, autos, things like that have slowed a little, but really couldn't see any major changes going through each of the subcategories. So we shall see. It may take another couple of months for spending to really slow down. If that's what those in charge seem to think is what is going to happen. I agree, because that really is the first domino to fall in the any downturn. As spending slows down, then business activity slows down, and then they lay off workers, and then those workers spend less, and just kind of that cycle. All right, where was I? The personal savings rate, which was around 6% pre-COVID, spiked during the pandemic, but has recently stabilized at around 3.5%. This lower savings rate may pose future challenges for consumers. On the manufacturing front, the Kansas City Fed Manufacturing Index fell to negative 13 in July from negative 8 in June, aligning with similar negative readings from the Richmond Fed. These figures suggest the upcoming national ISM report will indicate continued contraction in the manufacturing sector. All right. One last article from Zero Hedge. This is titled Market Moves Like These Have Not Ended Well. And this comes from QTR Fringe Finance. And Lawrence Lepard is the author, the subject of the article. All right. Lawrence Lepard's recent investor letter for Q3 2024, often overlooked by mainstream media, offers critical insights into the current economic and financial landscape. Here are a few key takeaways. And this is a pretty long article here, and there's actually a part 2 at the bottom. So if you want to go through this and get to the part 2, it's down here at the, right here. So anyways, let's scroll back up. All right. Number 1, precious metal performance. Silver outperformed expectations, breaking through the $26 to $27 an ounce resistance level in early April to settle around $30 to $31 an ounce. Historically, silver lags behind gold, but then moves higher and faster. This breakout is significant as it confirms a bullish trend in precious metal markets, with a falling gold to silver ratio historically indicating the onset of precious metals bull market. Gold also performed well, breaking through a 3-year resistance at $20.70 an ounce in March and reaching a high of $2400 before settling at around $23.75. Stock market resilience. Despite a rocky start in April, the S&P 500 rebounded strongly, reaching a new high by June's end, up 15.3% in the first half of 2024 and 81% since January of 2020. Investors seem convinced that the market's invincibility continued to buy the dip, a strategy that has worked well since 2008. However, Lepard's Lepard, is it Lepard or Lepard? Who cares? Warns of potential vulnerabilities due to record valuations and rising interest rates, which are beginning to impact consumption. He highlights the everything bubble driven by fiat money creation, suggesting a potential for significant correction. Economic risks, the high percentage of household assets in stocks, currently around 35%, mirrors the inflationary period of the 1970s, indicating potential for a large future drawdowns. The S&P 500's current position, significantly above its 200-day moving average, suggests a potential for a sharp correction, akin to those seen in 2000 and 2008. Lepard emphasizes that the ongoing bubble fueled by M2 money supply growth is particularly risky as it exists at the sovereign debt and currency level, not just in specific sectors like .coms or housing. Macroeconomic trends. The U.S. stock market is priced for perfection, but there are mixed signals. The bullish case includes global money supply growth, fiscal stimulus outweighing monetary restraints, and Wall Street's projection of continued earnings and revenue growth. When have they ever been wrong? The bullish case includes extreme valuations, historical technical extremes, and early warning economic signals such as declining PMI, negative U.S. economic surprise index, rising unemployment, and slipping consumer confidence. I would also throw in there the inverted yield curve, which has been upside down for 2 years. Inflation and the Fed policy. Inflation has decelerated from its 2022 high of 9.1%, with June's 2024 CPI print at 3%. However, private wages and salaries continue to grow at over 4%, complicating the Fed's efforts to cut rates. Lepard notes that the tight correlation between commodity prices and inflation, suggesting that inflation may resurge. This could lead to higher bond yields and lower stock prices, worsening the U.S. fiscal situation, especially if inflation combines with slower growth or a downturn resulting in stagflation. I'm looking forward to that. And lastly, political and economic outlook. Lepard expresses frustration with the current political climate. Telling me, criticizing both parties for perpetuating wasteful spending and debt buildup. Totally agree. I hate both sides. I would take all the people in Washington, put them on a boat, and shoot a torpedo at it. He warns that. He warns that regardless of the election outcome, Washington's tendency to spend will persist. I would say waste, driven by special interests and lobbyists. The recent assassination attempt on Trump and Biden's debate performance are seen as indicators of deeper systemic issues, with both parties seemingly out of touch with the needs of the American people. Lepard concludes that while the short-term outlook is uncertain, long-term risks of current economic and political trajectory are significant, emphasizing the need for prudent investment strategies in precious metals and a cautious approach to the stock market. Wholeheartedly agree. All right. Well, that's everything that I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. You can get all your financial needs right there. Just give me a buzz, shoot me an email. I'll be happy to help. All righty. Well, like I said, that's everything that I have. It is time for the weekend. Me and my main man, Jake, who's asleep over here on the floor, we're going to go out and play some ball for a little while, enjoy some cloudy afternoon, maybe get a little UV light anyways, and I hope you have a great weekend. So, all right, take care, everybody, and I'll talk to you next time. Adios.